Welcome everyone to everything you need to know about finance. Today, we're doing a deep dive. We've got, well, quite a stack of sources here, and we're jumping into a topic that's, definitely relevant for a lot of investors. QQQ and QQQM, two really popular ETFs. Our mission today is pretty straightforward. Pull out the key insights from this material, help you understand the main differences the sources point out, and maybe how investors might think about choosing between them based on what we're reading here.
That's right. We're sifting through these articles, research pieces, trying to unpack what looks like maybe a simple choice, but the sources really show it. It depends heavily on your own approach, your investment style. We want to bring out those critical details that, according to these experts, really set these two funds apart.
Absolutely. And look, this is crucial, something the sources themselves stress, and we have to echo it. This deep dive, it's purely informational. We're presenting data, insights, arguments found in these sources. This is not, and I mean not, financial advice. Okay. Investing has risks. Always do your own homework, your own research. And, talk to a qualified financial advisor before making any decisions. Right, with that said, let's dig into what these sources tell us about QQQ and QQQM.
Okay, so at their core, both of them, QQQ, that's the Invesco QQQ Trust, and QQQM, the Invesco NASDAQ 100 ETF, they're exchange-traded funds.
Yep.
From Invesco, they're basically baskets of stocks designed to give you exposure to a specific part of the market.
And the really foundational point here, confirmed across everything we've read, is they track the exact same index, both of them, the NASDAQ 100.
Correct, yeah, the NASDAQ 100, that's an index of the 100 largest companies.
Right.
Well, the largest non-financial companies listed on the NASDAQ exchange. So it's different from, say, the S&P 500 or indices tracking the New York Stock Exchange. The NASDAQ exchange itself goes back to 1971, really came into its own in the 90s, especially with all the tech companies.
Right, and the sources give us some scale here. QQQ is the veteran, the established one, launched way back in 1999. It's huge. One source puts it around, what, $289 billion in assets? That's as of May 2025 in the source material.
Yeah, enormous. QQQM is much newer, the baby brother maybe. Invesco brought it out in 2020. It's growing definitely about $31 billion according to the same source, but, significantly smaller, much younger than QQQ.
Okay, now it's something the sources really hammer home about the NASDAQ 100 and so about both these ETFs is how concentrated it is. This feels like a really, really important point they want investors to grasp right away.
It is. It's quite striking, actually. One source points out that 50% of the index's assets are tied up in just 10 stocks.
Right.
We're talking the absolute giants. Apple, around 9%. NVIDIA and Microsoft, both around 8% each. Then you've got Broadcom, Amazon, Meta, both kinds of alphabet stock, GOG and GOEGL, all in that top 10.
And the source description is pretty blunt, isn't it? Calling it as concentrated as the stock market has ever been at the top.
Yeah.
It even suggests it's like similar to the concentration back when QQQ first launched around the dot-com peak.
Yeah, that's a strong statement. And if you look at the sector breakdown from the sources, it kind of backs that up. Almost all U.S. stocks, naturally. But technology just dominates roughly 52% of the index. Then you have consumer services, maybe 16%, consumer cyclical around 12%. But even within those, the sources say it's heavily weighted towards those few big names. Consumer defensive, healthcare, they're smaller, around 6% each. Other sectors barely register.
Okay, so the big question then. If they track the exact same index, same super concentrated portfolio, both from Invesco, why have two? What did the sources say prompted creating QQQM when QQQ was already so massive?
Well, the sources explain it this way. QQQ became incredibly popular, especially with active traders, institutions, over, 2 decades. And because of that high volume, it developed this really deep, very liquid options market. Invesco saw that, but they also saw maybe an opening, a chance to appeal to a different type of investor. So they created QQQM. It's basically a clone, tracks the identical stocks, but it's structured slightly differently, mainly around the cost.
Ah, okay. Which leads us right into the key differences the sources focus on. And the first one, the most obvious one, seems to be the cost, the expense ratio.
Yes, exactly. That's kind of the main selling point for QQQM for a lot of people. QQM has an expense ratio of 0.15%. QQQ's is slightly higher at 0.2%.
Yeah.
No, that sounds tiny, right? Just 0.05% per year difference, 5 basis points. But the sources are quick to point out that difference adds up. It compounds over time. So if you're a long-term investor holding for years and years, that lower fee means QQQM should theoretically give you slightly better net returns than QQQ.
Makes sense. What about dividends? Do these funds, being so growth-focused, pay out much income according to what we're seeing?
The sources mention yields, yeah, but they're very clear. Don't mistake these for dividend investments. They're not. One source gives QQQ's yield at 0.56%, QQQM's at 0.66%. Another source actually lists them both at 0.57%. So the exact figure might fluctuate a bit, but the takeaway from all the material is consistent. The yields are low, very low. These ETFs are really about betting on the growth of those underlying companies, not getting regular income checks.
Got it. Okay, now here's where that other major difference comes in, the one tied back to why QQQM was created, liquidity and trading volume.
Right. And this is a big difference, one the sources really emphasize. QQQ is just massively more liquid than QQQM. It trades, on average, something like $17 billion worth of shares every day. QQQM, well, it trades. It's not illiquid, but it's much, much lower volume, closer to maybe $350 million a day, according to the sources. Huge difference.
And the sources directly tie that huge volume difference to the options market, don't they?
Precisely. Because QQQ trades so much, it supports what the sources call a robust, very deep, very liquid options market. This is absolutely vital for professional traders, big institutions, anyone using option strategies, hedging, speculating, generating income. QQQM's options market, on the other hand, is described as thin. Much less activity, wider spreads probably. So the sources are pretty clear. If you plan to trade options actively on your ETS position, that liquidity difference really points towards QQQ.
Okay, so let's recap the differences so far. Holdings, identical. Performance, almost identical. Tiny edge maybe to QQQM over time due to fees. Key differences. Fees favor QQQM, while liquidity and options favor QQQ. What are taxes? Anything there? Sources mention tax efficiency for both.
Yeah, that's a benefit they both share, according to the sources. Compared to, say, a traditional mutual fund tracking the same index, ETFs like QQQ and QQQM tend to be very tax efficient. It goes down to how they're structured, this creation and redemption process. Basically, large investors swap baskets of the underlying stocks directly for ETF shares and vice versa. This avoids the fund manager having to constantly sell stocks within the fund, which would generate capital gains that then have to be distributed to all the shareholders. So yeah, generally less likely to hit you with unexpected tax bills compared to mutual funds.
Okay, we've covered expense ratios, taxes, kind of the typical costs. But one source makes this really powerful point about what the biggest cost actually is.
Yes, this is a really interesting insight in the material. The argument presented is that, look, the biggest cost you face as an investor, it isn't that 0.05% fee difference or even the tax drag over time. The single greatest cost you can possibly incur is suffering huge losses when the market tanks, losing a big chunk of your capital in a downturn.
That really reframes things, doesn't it? It sort of shifts the focus from just optimizing tiny costs to really thinking hard about risk management, which seems especially relevant for funds like these, given the concentration we talked about.
It absolutely does. And it leads directly into how the sources talk about choosing between QQQ and QQQM based on who you are as an investor. They basically say the choice often boils down to, are you primarily a long-term, set-and-forget-it, buy-and-hold investor, or are you more of an active trader, maybe someone who uses options?
Okay, so based on the sources, if you're that first type, buying shares, holding for the long haul, maybe for retirement, decades away, which one do they suggest makes more sense?
For that profile, the long-term buy-and-hold investor, the sources generally lean towards QQQM. And the reason is simple, that lower expense ratio. 0.15% versus 0.20% over 10, 20, 30 years. That small difference really compounds and can lead to noticeably better net performance, all else being equal. The super high trading liquidity of QQQ, it just isn't that valuable if you're only buying once in a while and holding on.
Right. But then, flip side, if you're trading more actively, maybe moving in and out based on market conditions, or definitely if you're using options.
Then yeah, the sources pretty strongly suggest QQQ is the better fit. Its huge daily volume means you can generally get in and out quickly with minimal price impact, what traders call low slippage. And crucially, as we mentioned, that deep liquid options market is essential for efficiently executing many option strategies. The sources say QQQM's thinner options market just doesn't offer the same ease or potentially cost effectiveness for active options traders.
Makes sense. The sources also bring up some timeless advice here, things like buyer beware and, importantly, know yourself.
Yes, and this really ties it all together, doesn't it? It's easy to get caught up in hype or just chasing past returns. The sources remind us that understanding your own goals, your time frame, how much risk you can stomach, that's absolutely critical before you pick any investment, especially one like these, tracking such a, concentrated and historically volatile index. They caution against letting greed take over, especially maybe after a big run-up, instead of focusing on managing potential downsides.
And they connect this self-knowledge to how much you're investing and when, right?
They do. The logic presented is kind of like this. Someone putting away, say, $100 a month for the next 30 years might view short-term bumps very differently than someone thinking about investing a large lump sum right now, particularly if the market has just had a huge rally. The sources imply that second scenario demands a much more careful, maybe even skeptical, assessment of the risks versus the potential rewards. Protecting your capital becomes maybe even more important than chasing the next percentage point of gain.
Speaking of risks and rewards, the sources do look at recent performance, but they frame it with a pretty stark historical warning.
Yeah, the recent performance has been, well, wild. The forces note these funds gained around 55% in 2023, huge year, but that came right after they dropped over 32% in 2022. So massive swings.
And one source used a simple example to show how that volatility played out over that 2-year stretch.
Right. They crunched the numbers. If you'd put $100 into QQQ or QQQM at the end of 2021, held through the big drop in 22 and the big recovery in 23, by the end of 2023, your $100 would only be worth about $104. And the kicker, the source points out, you could have earned more over those same 2 years just by holding super safe U.S. Treasury bills.
Wow. That example really drives home the source's warning about, not getting too fixated on recent hot performance, shows how quickly things can change.
It absolutely does. And they really underline this risk by bringing up the big one, the dot-com bubble bursting. The sources remind readers that from its peak in early 2000 down to the bottom in late 2002, early 2003, QQQ lost a staggering 83% of its value. 83%. And the material explicitly notes QQQM, tracking the same index, would have suffered just as badly if it had existed then. They don't just mention this as ancient history, they use it as a vivid illustration of the kind of potential drawdown risk you take on with a highly concentrated growth-heavy index like the NASDAQ 100, especially after periods of euphoria.
Yeah, that 83% number. Thinking about that alongside the current concentration levels the sources described earlier, it certainly highlights the potential downside, doesn't it? Even with the amazing growth potential.
It really does. It reinforces the message for the sources that yes, the potential for big gains is there, absolutely. But the potential for equally dramatic and sometimes very fast losses is also baked into the cake. And history shows it can happen.
Okay, so wrapping this up, based on everything we've pulled from these sources today, the core decision point they present between QQQ and QQQM seems pretty clear-cut, depending on the investor.
It really does seem to boil down to that. QQQM, with that slightly lower fee, is positioned by the sources as likely the better choice for the long-term buy-and-hold investor who's focused on minimizing costs over many years.
While QQQ, with its massive liquidity and very active options market, is presented as the go-to for active traders, institutions, or anyone needing that flexibility and options capability.
Exactly. And the sources consistently conclude that the right choice isn't universal. It depends entirely on you, the individual investor. Your specific financial goals, how long you plan to invest, your style buy and hold or more active trading, and crucially, your understanding of and comfort level with the inherent risks of this particular slice of the market.
Which brings us to a final thought, building on what we've discussed from the sources today. Considering that extreme concentration, half the assets in just 10 stocks, and knowing the NASDAQ 100's history, including that devastating 83% drop, how does an investor truly get their arms around managing that kind of concentrated growth risk today, even while hoping for those high returns? And how does that advice from the sources to know yourself really translate into action when you're looking at investments capable of such huge swings, especially in a market environment that feels, well, maybe a little frothy to some? Something to think about.